In this video, we will be considering the causes and consequences of a current account surplus. The current account is a section of the balance of payments that comprises trade in goods, trade in services, primary income, and secondary income. The balance of payments is a record of the transactions of a country with the rest of the world. The current account balance is the sum of the balance of trade in goods, trade in services, primary income, and secondary income. What is a current account surplus? A current account surplus occurs when the inflow of money exceeds the outflow of money from trade in goods, trade in services, primary income, and secondary income. In other words, the receipts in the current account are more than the payments. The current account balance is positive. The table shows the current account balance in largest surplus and deficit economies. China's current account surplus rose from $249 billion in 2020 to $317 billion in 2021. Germany, Japan, and Russia also had huge surpluses in their current accounts. The US had a huge current account deficit of $822 billion in 2021. This is shown as a negative value. The causes of current account surplus include high exportation and low importation, exchange rate depreciation or devaluation, protectionism, competitive products, high level of productivity, weak domestic demand, high savings ratio and investment. High exportation and low importation is the major cause of a current account deficit. The excess of exports over imports would result in a current account surplus. This is the major reason for a current account surplus, because the trade balance, which is exports minus imports, is usually the largest part of the current account. The other components form a small fraction of the account. Therefore, there is always a little difference between the trade balance and the overall current account balance for most countries. If exports exceed imports, money outflow from the economy will be less than the inflow, leading to a current account surplus. Most of the factors that cause current account surplus affect the trade balance, in that they may increase exports or reduce imports. Therefore, the other factors we will be considering will influence importation and exportation. Another cause of a current account surplus is exchange rate depreciation or devaluation. Exchange rate is the value of a currency in terms of another. A fall in the value of the currency, due to the forces of demand and supply, is depreciation. Devaluation is the lowering of a currency value by the government. Depreciation or devaluation of the exchange rate means the price of a country's currency is low, relative to another country's currency. Consequently, the exports of that country will become cheaper, while its imports become more expensive. This will increase exports and decrease imports, causing a current account surplus. Protectionism. This involves the use of policies to restrict free trade and protect domestic businesses, e.g., tariff, quota, and ban. For example, tariffs, which are taxes on imported goods, increase prices of imports and decrease imports. There will be a current account surplus when imports are less than exports. High-quality products increase the competitiveness of a country's products in the international market. Consequently, demand for its products in foreign markets increases. More exports can cause a current account surplus. High level of productivity is another cause of current account surplus. High productivity in a country shows that the economy is getting maximum output from its resources. The factors responsible for high productivity in a country include good infrastructure, high technological development, superior educational system, good healthcare system, etc. If productivity is high, there will be enough goods available for export. This will cause a current account surplus. The next factor is weak domestic demand. If demand is low in an economy due to a recession, for example, businesses will sell their products abroad. Note that in a period of recession, there is low income to be spent on both domestic and imported products. Increased exportation and reduced importation would cause a current account surplus. High savings ratio and investment. The proportion of incomes of households that is saved is called savings ratio. Investment is the purchase of capital goods, e.g., machines and equipment. High savings ratio means that an economy can mobilize more funds for investment purposes. High investment leads to high national output. As a result, there will be enough goods available for exportation, which may cause a current account surplus. The chart shows China's sectoral saving and investment. Saving and investment were expressed as percentage of GDP. Both ratios for enterprises, in blue color, increased between 2000 and 2003. This shows that as saving increases, investment increases. Next, we are going to examine the consequences of a current account surplus. A surplus on the current account may not necessarily be a good thing. So, the consequences are positive and negative effects. Note that the cause of the surplus would determine whether it is beneficial or harmful. The consequences include exchange rate appreciation, inflation, low standard of living, more investment abroad, and bad relations with other countries. Exchange rate appreciation. A rise in exports will increase the demand for the currency of the exporting country and cause a current account surplus. An increase in demand for a currency will increase its value against other currencies. A rise in the value of a currency in relation to another currency is known as appreciation. An appreciation makes exports expensive and imports cheaper. Consequently, exports will decrease while imports will increase. This can correct the surplus in the account later. In addition, imported raw materials are cheaper. This can reduce cost-push inflation. Cost-push inflation is the type of inflation caused by a rise in the cost of production, such as raw materials cost. Inflation. A current account surplus can cause demand pull inflation. Demand pull inflation is the type of inflation caused by a rise in total or aggregate demand. A rise in exports, which causes a current account surplus, will increase the demand for the products of the economy. An increase in demand for the country's goods abroad can cause the scarcity of essential goods in the economy. This results in demand pull inflation. Prices of essential products will rise due to scarcity. Low standard of living. More exports, less imports result in a current account surplus. A fall in demand for imported goods is an indication that incomes are falling. Therefore, there is less access to many products produced in other countries. So, standard of living reduces as people have access to few products. More investment abroad. A current account surplus means there is a net inflow of money into the country. The economy has a large amount of fund for investment in domestic or foreign businesses. More investment abroad produces more incomes for the citizens of the country, e.g., profits and dividends. The last consequence is bad relations with other countries. If a country experiences a surplus by imposing tariffs on imported goods, other countries will retaliate, thereby leading to a trade war. This will not promote friendly relationship with other countries.